Let's continue the theme of markets, particularly what's driving markets. Geoff Wood from Morphic Asset Management joins us now for more from our Sydney CBD studio. Craig, Sydney, before Geoff mentioned the French elections and certainly the positive sentiment that's been derived from what is believed to be an ultimate Macron win. I mean, do you agree with the likely outcome as well as the sentiment that's been attached to it?
I do. I mean, one of the things that happens in France is a lot of people get polled in terms of who you're going to vote for in the runoff, which is the vote that we just had over the weekend, and then who you're going to vote for if this scenario comes out about in the second place. So a lot of the French electorate have been asked, if you put Le Pen against Macron, who would you vote for? And currently it's looking like Macron will win by about 65 to 35. So it's a pretty significant margin and a big enough margin to help the markets be pretty relaxed about where the direction of things from here.
I personally thought one of the other significant outcomes from certainly the first round of the presidential elections was just the fact that the polls for once got it right.
Yeah, I know, what a novelty. I mean, I think that was enough to give the market a bit of anxiety going into the weekend, in that no one really feels like they can trust polls anymore, but they absolutely nailed this one. But in part, that's why we've seen such a large relief rally when the markets came in on Monday, because there was a fair amount of guys and girls sat on the bench just waiting for the actual result.
Does it fade though? Do you think do markets shift their focus now? Under the impression that this is pretty much a given and move to other events? And if so, what do you think becomes the major focus for markets?
Very much so. I think this is something that sort of had people spellbound for a while, and once you move through this, you move on to looking at the next events. And so I'd say the Fed are now back in play. June had got down to sort of being less than 50-50 priced in the US. That's now back up to much more of a certainty, and there's still hikes you can arguably put into the front end of the US curve. So the Fed hike cycle's back to be discussed again. And then tonight we've got Trump to round off a week of politics, where he talks about the unveiling of his tax policy.
Yeah, and we'll talk about that. I don't know how much of a policy it's going to be as opposed to a bit of a wish list. But just staying with the Fed, and would you be of the opinion, like the market is, of 2 more rate hikes? And does that stay the case if, as some people have suggested, this reflation trade is come to an end, or at least on hold?
Well, I mean, I'd say the market right now is pricing sort of 1 to 1.5 hikes for the rest of the year. The Fed themselves see June as a bit of a certainty, so the market's a bit on the underside there. Next year and the year after, the market's got around about just over 1. So there's certainly a lot of fat that you can book back into there. And I think the big debate over the back end of Q1 was the hard data versus soft data, where the surveys were looking very strong, but the hard data wasn't necessarily supporting it. I mean, my view would be that the hard data is actually going to come to the soft data, and we're going to see a very strong Q2 GDP print in the US. So.
Oh, it's because I was going to say there's been some interesting commentary and a few articles written about a potential Trump recession, the idea being that he's unable to get any of these policies, these sort of economic stimulus policies through, and yet you've got the Fed at the same time hiking rates, not taking into consideration any sort of fiscal stimulus, and you've seen this sort of flattening of the curve.
Yeah, that's correct. But I'd say that most people out there would say that at the moment the Fed policy rate is still stimulatory. By their own metrics, they're probably about 1%, so 4 hikes under what they'd consider a neutral rate. And a neutral rate is where you're neither stimulating nor contracting. So if they do a couple there, it's unlikely that that's going to turn out to be a mistake in the short term. And when it comes to Trump, what he's doing cleverly, and he'll unveil tonight, is he's trying to make the policy a bit more friendly for the Democrats, because he sort of got stood up by his own party with the healthcare reform. So he's trying to get a broader base buy-in, which is obviously quite a clever tactic.
Is it enough? I mean, is it going to be enough for markets to continue to just see this sort of wish list, if you like, as far as policy is concerned, and then just hope that it actually gets through Congress? Because that seems to be the play by him.
I think that's right. I mean, that's the way he ran the whole pre-election, and that's how it's happened now that he's the president. But I don't think markets will react tonight. In that it's just another Trump show where it'll be a lot of hot air without much detail. And the market, we're nearly 6 months in here. The market wants to see detail at this stage. So I think it'll get a lot of coverage, but I don't think the markets will react at this stage.
Can I ask then what Morphic are doing? I mean, in this sort of an environment, we look at the US, for example, NASDAQ kicking through 6,000 for the first time. You know, we've got the other indices not far off all-time highs. We're now predicting once again 6,000 on the local market. Europe's starting to look good again. I mean, where are the opportunities as you see it?
Well, I think the most important question you ask yourself first is, should you be invested or not in the global markets? And the answer to that we have is yes. We had the all countries world index breakout to new highs on the back of this move in France. So, you know, as people say, the trend is your friend, and we're still in this bull market that is so unloved. I mean, it's very rare to find a hand on heart bull out there, and so fund managers continue to hold cash. So the story for more money to pour into equity markets is still solid. So that's the first point. And then the second one is, Europe is starting to look more better with these geopolitical risks out of the way. So a lot of fund managers are reallocating money out of the US into Europe, because US is sort of broadly 20% more expensive.
All right, Geoff Wood, brilliant as always to get your thoughts. Thank you.
Thanks very much.
Geoff Wood over at Morphic Asset Management.